Hi, and welcome to the Downtown Pittsburgh Investors Business Daily Meetup. This is the September 2016 presentation. My name is Eric Rossi, and I'm a co-organizer of this meetup group. And if you're happening to find this video on YouTube, you can find our meetup group using the link shown on this slide. So the mission statement of this group is to educate individual investors about the CAN-SLIM investing strategy. So this means identifying the best educational material that's available. And this presentation is for educational purposes only. I'm not recommending any stocks to buy or sell. Investing in stocks does carry substantial risk and you can lose your capital. I'm a non-professional volunteer investor. Investors Business Daily, IBD, and CAN-SLIM are registered trademarks of Investors Business Daily Inc., and Meetup is a registered trademark of Meetup Inc. And this is a new slide this month. This is kind of a prerequisite for these videos because if you don't have the prerequisite material down, you might be kind of confused or you might be kind of lost in this video. So this video and all the videos that I've produced in the past year assumes that you're familiar with the CAN-SLIM investing strategy, which was developed by William J. O'Neill, who's the founder of Investors Business Daily. So at a minimum, I'd say that viewers should read How to Make Money in Stocks by William J. O'Neill before viewing this video. And you can see a picture of the latest edition of that book right on this page. So again, you're certainly welcome to watch the video if you don't have the prerequisite material, but it just might be a little bit confusing. You'll definitely get more out of it if you have a basic understanding of CAN-SLIM investing before watching this video. Topics for this month, we'll do the market dashboard as always. Then I'm going to do one of the letters from CAN-SLIM. So each letter in CAN-SLIM stands for part of the strategy that Investors Business Daily has developed. So this month we'll talk about the C in CAN-SLIM. Then I'll talk about a quarterly review now that we're at the end of the third quarter of 2016. Then we'll do the market analysis, and I'll talk about a couple recent trades, and then we'll conclude. Market dashboard, at the time I prepared this, the market was in a confirmed uptrend, so we get a green for that. The uptrend health, this uptrend is quite long in the tooth. It's been 93 calendar days, so it's been about 3 months since this uptrend started. So this is quite long in the tooth, and as we'll look at later during the market analysis, the uptrend seemed to have lost some steam for the time being, and we're trading sideways. So it's not a terrible time, but it's certainly better to get in these uptrends early on. So this one gets a yellow. Distribution days, we have 7 distribution days on the S&P 500, 3 on the NASDAQ. So that's a red because of the high count on the S&P. And the Fed activity, the Fed is expected by most people to raise rates this December, which would be the second rate increase, as the first one was last December. So they haven't committed and said, yes, definitely we're going to do it, but it looks likely that they will do that. And it looks doubtful they're going to do anything before December because we have the presidential election coming up. So the election is going to be somewhat disruptive to the market, and especially as we don't have a clear winner right now. So I doubt that we'll see the Fed make any moves here in November because they probably won't want to further disrupt the market. But anyways, this gets a red since we are in an environment of raising interest rates. And then the S&P 500 right now has an accumulation distribution rating of C+. That's just a proprietary rating that IBD gives to all their stocks, and they also give them to these major indices. So we've got a C+, that's a yellow. The NASDAQ has a B-, that's a green. And the IBD 50, which is a composite index of the top 50 rated stocks by IBD, top 50 growth stocks. This one, they don't assign accumulation distribution rating to this one, but it is trading above both of the major weekly moving averages, so I'm giving this one a green. And then this is unchanged. This has been unchanged for a long time. The last bull market, the current bull market, I should say, started in March of 2009 or started in 2000, yeah, in March 2009. So it's actually the longest running bull market since at least 1970. I don't know if it's the longest running bull market in history, but I talked about this in a prior video, how IBD had some stats on the length of bear markets and bull markets going back to 1970. So we're still in the bull market, but it's very long in the tooth. We could be transitioning to a bear market, which I'll talk about in the market analysis, but it's unclear right now. So this gets a yellow. The last bear market ended in February 2009 after the financial crisis. So it's been a long time since we've had a bear market. So this gets a red. And the reason for that is that when we do get a bear market, it has a way of resetting things. Tend to get a new sectors tend to rotate, and as we emerge from a bear market or a major correction, that's often in those early stages of the new uptrend, and the new bull market is often where the biggest gains are made. And intermediate corrections, these are smaller corrections in the NASDAQ of 5 to 15%, or 10 to 15% rather. There's been 9 of these that I count since March 2009, which is a very high count. So that gets a red. So overall, you can see the dashboard's pretty mixed. We've got some green, some yellow, and some red, almost an equal part of each. So it's okay to trade stocks right now. It's not an ideal time, and I wouldn't necessarily expect to get huge return, a ton of huge winners right now. But there have been some, which we'll talk about. So CAN-SLIM is the acronym developed by William J. O'Neill to describe his methodology of investing in growth stocks. And I got this suggestion from one of our members last month to cover one letter of CAN-SLIM each month as a review for everyone. So this month we're going to cover the C, which is current earnings. And you can see all the other parts of CAN-SLIM here. A stands for annual earnings, N stands for something new, S is supplier demand, L is leader or laggard, I is institutional demand, and M is the market. So the material I'm covering here about the C, about current earnings growth, is from Chapter 3 of How to Make Money in Stocks. And it's a short chapter, so there's not a ton to talk about here for the C. All right, EPS is earnings per share, and that's defined as the total profits of a company divided by the number of shares outstanding. So companies will issue earnings reports each quarter, and in those earnings reports they will issue and tell their earnings per share number. And that'll be something like 30 cents per share, $1 per share, negative 20 cents per share. So that's earnings per share. Now in IBD they have something called the EPS rating, and that rating is different than what the companies actually report. The EPS rating by IBD is a proprietary measure of a company's earnings growth. And I made a note here that this actually includes quarterly and annual earnings growth. So the EPS rating in Investor's Business Daily, which goes from 1 to 99, 99 meaning that company their earnings growth is outperforming 99% of other companies. So that rating takes into consideration a number of things. It takes into consideration recent quarterly earnings growth. It also takes into consideration recent annual earnings growth. And it also takes into consideration acceleration in earnings. So I just want to distinguish between those two things. EPS rating in IBD, that's a proprietary rating. Earnings per share when companies report it is, there's a standard formula for that. So the key here is that you want to select stocks with a large percentage increase in their current quarterly earnings as compared to the same quarter in the prior year. So what that means is we're coming into right now we're coming into earnings season. In fact, Alcoa reports this week, which is often considered the kickoff of earnings season. So Alcoa is going to report their earnings from the last quarter, and if you compare those earnings to the year prior in the same third quarter, and then you calculate the percentage increase, and that's what you want to look at. You want to see a high percentage increase from the same quarter in the year prior. And the reason that that Bill O'Neill recommends that as opposed to comparing it to the previous quarter, which in this case, Alcoa reports this week. We don't want to compare that to the second quarter of 2016 because we want to take into consideration seasonality. A lot of companies tend to have their sales and their earnings tends to vary by quarter, and some quarters are better than others. For example, if you're a retail stock, you're probably going to have higher earnings in that last quarter of the year because people are spending money for Christmas, buying gifts for people. So Bill O'Neill recommends 20% or more earnings growth on a quarterly basis. I know other people like there's a famous investor, his name's Dan Zanger. He actually holds the world record for portfolio return. He looks for 40% or more. And the bottom line here is that the higher the number, the better. So if you can find triple-digit earnings growth, some recent companies that have showed triple-digit earnings growth are Acacia Communications and Momo. So some of these big winners, I believe Weibo as well. Oftentimes these big winners will have triple-digit earnings growth. So if you want a way to really narrow down stocks you're screening, you can actually just look for triple-digit earnings growth, although you'll come out with a very small number of stocks that way. So accelerating earnings growth on a quarterly basis is even better. So if the percentage change for this quarter is let's say 50%, and the last quarter's percentage growth was 40%, and the one before that was 30%. So we've got 30%, 40%, 50%. That's a very good sign, and that's something that you definitely want to look for. If earnings growth is accelerating, then that's even better. Earnings growth should be accompanied by sales growth, although sales growth will often show a smaller percentage increase than earnings. And that's just an observation I've made. I didn't pull that second statement out of Bill O'Neill's book, but I haven't seen too many companies that had triple-digit earnings or triple-digit sales growth. Usually, if earnings growth is triple digits, then you might see sales growth in the high double digits. But the point here is that you don't just want earnings growth, because without sales, a company can't sustain earnings growth for the long term. So they need sales to drive the earnings. So where can you find information about current quarterly earnings growth? There's many places, but there's a few within the realm of IBD that I'm going to talk about. One is on the IBD mini charts, one is on the stock checkup, and then one's on MarketSmith. So this is an IBD mini chart of Gigamon, and this has been a good stock this year. So looking here at earnings growth, we've got this EPS rating right here, this 95 EPS. That is the proprietary IBD earnings per share ranking. So what this is telling you is that considering the current quarterly earnings growth, annual earnings growth, acceleration, I believe it also includes earnings stability, because you want a company that is relatively predictable in their earnings. It's better to have a company. One I can think of was Chipotle and Priceline. Both of those were very consistent. Every quarter they were generating a pretty predictable percentage increase. And if you're an institution, that's really nice because you have a little more predictability than if a company has 300% earnings growth this quarter, and next quarter's 25%, and then it's up 80%, and then it's down to 50. It's nice if you won't often find a company with really high earnings growth and really consistent is just what I've seen. I think the higher the earnings growth numbers, especially in the triple digits, the less likely that you see a lot of consistency and repeatability on a quarterly basis. But anyways, this means that Gigamon has an EPS rating of 95, so they're outperforming 95% of other companies. Okay, right here we have annual EPS growth plus 35%. This means that annual earnings has been growing at a rate of 35%. So that's pretty good. You'll generally see higher numbers on a quarterly basis than you will on an annual basis. again, just my observation. Underneath here it says last quarter EPS was 88%. This means that last quarter, the second quarter of 2016, earnings increased 88% as compared to the same quarter the year prior. And this up arrow here means that they have revised recent estimates upwards. So companies often will provide an estimate for the next quarter. So this arrow means that they've increased what their initial estimate was, which is a good thing. And 88% earnings growth is fantastic. It's not triple digits, but it's very good. Next quarter EPS estimate is 41% increase. So that means for this quarter, the third quarter, they're predicting a 41% increase from the third quarter in 2015. And this tells you the sales here. Last quarter sales was up 46% compared to the same quarter the year prior. Like I said, you'll often see earnings growth is higher than sales growth, and you can see that here. But we do have good sales growth here to drive the earnings growth. If sales growth was like 5%, you're probably not going to sustain an 88% quarterly earnings growth. So the 3 quarters average EPS is 73%. So this just says the last 3 quarters are averaging 73% increase. And then here it tells you EPS is due October 20th, meaning that Gigamon is due to report earnings on October 20th. Okay, so that's how you can find some of this earnings, some of the information about current quarterly earnings in the IBD mini chart. Like I mentioned, this EPS rating here is a proprietary rating, and it includes the C and the A in CanSlim. It includes quarterly earnings and annual earnings. So you're not just getting the C here, you're getting the C and the A. But if you just want the C, the quarterly earnings growth, that would be right here, and right here. All right, on investors.com, there's a tool called the Stock Checkup, which gives you a printout of a bunch of fundamental and technical analysis of any stock. So this is an excerpt from the Stock Checkup for Gigamon, same company we just looked at, and you can see you get a lot of the similar information that you get on the mini chart. Okay, the nice thing about the Stock Checkup is that it's a little bit easier to read. It's not as condensed on the mini chart. And you also get, over here, you get a green, yellow, or a red based on IBD has set up certain criteria here. So you can tell at a glance here, if you see a lot of green on the fundamentals, that's a good sign. But you can see here, this is a lot of the same information we had in the mini chart. One thing we don't get here, a couple things. Number of quarters of EPS acceleration is 2. So that means that earnings has been accelerating the past 2 quarters, which is again a good sign. And I like to see a smaller number here usually, because if earnings has been accelerating for 10 straight quarters, I haven't seen companies sustain that for very long. I haven't seen too many here reach much higher than like 5 or 6 quarters of acceleration. And the other 2 things here that we didn't quite get on the mini chart. Earning estimate revisions. It's interesting, this says NA, even though we had an estimate revision on the mini chart. But this should be the same thing that was on the mini chart. And then the last quarter percent earnings surprise was 25%. So that means that they beat the expectations by 25% last quarter. And companies that beat expectations generally are more favorable, and that usually means that the market reaction, the market reaction is likely to be favorable, although it's not guaranteed when they do report earnings. Okay, and lastly, this is how to find the C in MarketSmith. There's on the lower left-hand side of MarketSmith, there's a really nice table here which shows you the quarter ending here. This is the actual EPS, the actual earnings per share reported. Okay, like I said, this is the actual, so 29 cents earnings per share. outstanding. This is not the IBD EPS earnings per share rating. Then this is the percent change in earnings from the same quarter a year prior. So September 15 was 0.25 as opposed to 0.29 earnings per share EPS in September 2014. So this actually dropped by 0.04, and that's why you're seeing a negative number here. Okay, and likewise for March, let's say 0.32 compared to 0.11, this is about 3 times that, right? So this is a 200% increase from that, meaning 0.32 is 191% increase compared to 0.11. But for this particular stock, you can see these numbers are really good. And like I said, when you see triple-digit numbers in here, I haven't seen very many companies sustain that quarter to quarter. But you can see this company's got very strong earnings growth, and they had one quarter here which maybe was just an anomaly. I wouldn't give that a whole lot of credence, but you know, recent earnings the past 3 quarters very good, and you can see we've got some triple digits recently. And sales growth in this one's a little low. I'd like to see more like 20% or more. And we've got a couple negative quarters. So there's some sales growth here. You know, usually companies with numbers like this are going to have a hard time sustaining a really high earnings growth. And then the other way to find the C in MarketSmith is at the bottom of the page. They show the last 4 or 5 quarters. And they'll say, okay, so for the quarter ending June 30th, which was the last quarter reported, this company reported 0.41 earnings per share versus 0.16 the year prior. So 0.41 in June compared to 0.16 in June of last year. And then they tell you the percent change, 156%, same as here. And then they give you the sales growth. So they did 242 million in sales compared to 209 million the year prior. So that was a 16% increase. So it gives you that same information here 2 different ways in MarketSmith. All right, so if you don't have Bill O'Neill's book, I recommend going to buy it. It's not that expensive, and it's going to return to you many more times what you pay for it. In fact, it's kind of amazing how cheap some of this educational material is, considering the money it can make you over your lifetime. But you can also learn about CanSlim on investors.com. And if you go to the How to Invest tab up here, and then click on the CanSlim investing system, you'll get, in fact, it's spelled out here. You can't see it, but CanSlim is shown here. You could click on the C, and it'll talk about a lot of the things that I just talked about. All right, next topic is a quarterly review. As we just finished the 3rd quarter of 2016, it's a good time to review your performance. Review the trades you had in the prior quarter and see how you're doing. How's your portfolio doing overall? So these are some questions to consider while doing your review. Which types of trades are working the best? All right, if you do different types of trades, like day trades and swing trades and position trades, which ones are performing best? Okay, next question is what setups are working best? Are you having the most success with cup with handle bases or IPO bases or some other setup? It's good to understand that because you can then know for next quarter, maybe I want to focus a little more on the setups that are doing the best right now. And then which entries are working best? Standard buy points, so like a cup with handle standard buy point, or earlier buy points. In other words, buying while a stock is in the process of basing. Did you follow your rules with each trade? And if not, why didn't you follow your rules? Oftentimes that'll be because you had your emotions got the best of you. If you took a loss, and I think this is the most important question to ask here. If you took a loss, then why did that happen? And what could have turned the loss into a gain? I find this to be the most useful question to ask, and the one where you can really learn the most about how to improve your results. Then what was your average percent return, and how many positions were winners and losers? And I wouldn't get too hung up on that, but it's useful to know. I think it's useful to have that information. So you want to compile your results and then look for trends in the results. And then create an action plan to improve your performance for the next quarter. And then track your progress to ensure that you are executing those actions. So as an example, I posted my quarterly review on the Meetup page under the file section. And here's the example. Here's my results. I was profitable about half my trades, and I made 15 position trades, which are longer term trades, and 34 swing trades. The average return was 0.5% per trade. The average holding period was 11 days. Alternate entries outperformed standard entries, and IPOs gave me the best, or IPO bases gave me the best returns. So I didn't have a great quarter. I was trading too much, and I think I would have been better suited to actually trade less and really look for the best setups. So here's an action plan I came up with for this next quarter so that I can do better. Avoid buying stocks that are too extended from their key moving averages. This is more so for swing trading. I found that if I buy stocks that are 3 to 5% or more from the 10-day moving average, that can be a riskier time to buy, more likely to take a loss. Number 2 for me is huge. Buy stocks while they are basing rather than waiting for the breakout. And this is an area where, if mostly what IBD teaches is to buy base breakouts. And I actually think right now in today's environment, that's not the best strategy. A lot of these base breakouts over the past year or two are not working very well. So I want to establish a full position before the breakout, because I've just seen too many times where it breaks out and then reverses and you get a lot of volatility around the breakout point. So if you get in early, then you can sit through that volatility. If you buy the breakout, you might get stopped out for a loss. And number 3 is another big one. Before selling near the stop loss, I now evaluate potential nearby support levels, nearby moving averages, and overall market action for the day. So I'm not just selling anymore because my stock hit my stop loss. Okay, I'm going to look at what's the market doing today. Is the market up or down? Okay, if my stock is hitting its stop loss and the market's down and the market's continuing to go down, then it's likely to continue dragging my stock down, and I'll be more inclined to sell. But if the market's up, then there's a good chance the market will pull my stock up later in the day. Also, if a stock is hitting my stop loss, but it's near an expected support level, like a 50-day moving average or a 10-day moving average or a hold number like 50, then I'll give it a little more wiggle room. Whereas if a stock hits the stop loss, it's not near any moving averages or expected support levels, and the market action is weak, I'm inclined to then sell it more quickly. So I'm just looking a little more at context now instead of just selling because my stop loss was hit. Setting stop losses is a must in trading to control your losses. But if a stock's consolidating in a constructive manner and especially in low volume, I'm gonna give it a little more wiggle room and not necessarily sell it just because it hit my stop. All right, that's just me. You could certainly be robotic about it and say, well, my stop was hit, I'm out. But I've just found that's gotten me out of positions too soon when I could have, and ended up costing me a lot of money. And then the last action I had was to don't make more than one new trade per week, because I think I'm over trading, especially this last quarter with 49 trades in one quarter. That's a little crazy. I don't recommend doing that unless if you're doing this for a living and you're day trading, then obviously that's okay. But if I'm trying to focus now on positions and holding a little more long term and not be constantly chasing the latest setup that I like. So like I mentioned, if you want to see my quarterly review table, it's in the file section on the group's Meetup site. And with that, I'm going to switch over to MarketSmith, and we'll do a market analysis and look at some recent trades, and then we'll wrap up. Okay, I'm back here with the market analysis. So let's start with the NASDAQ. On the monthly chart, you can see this was the bear market of 2008 because of the financial crisis. Since then, we've been following this really nice trend all the way up here, which was broken over a year ago. And since then, we've basically been trading sideways here. And you can see we are trading near all-time highs, and we are trading at highs that are above what was experienced in the technology boom in March 2000. So last month, September, you can see the NASDAQ was up for the month on some decent volume. So overall, it's good. It was a good month. On the weekly chart, you can see recent highs were here around 52.32. We're trading a little bit above that. We're above both the 10-week and 40-week moving averages, which is good. And over the past month, you can see we've had some decent volume up weeks and one down week in lower volume. So that's looking good. And on a daily chart, again, you can see we're for really since about August, we've been trading mostly sideways. And we've got the election coming up here, which is probably going to be a catalyst for a move up or down after the election's known. But I wouldn't be surprised if we keep seeing some sideways action trading in as people are waiting to see what happens with the election. And if we look at the IBD 50 index, this is a composite index of the top 50 growth stocks by IBD. You can see that we had a couple in the past month. We had a couple good up weeks and decent volume. We're not quite trading. We're not making new highs here on this index, but we're pretty close. And on a daily basis, again, you can see that same kind of sideways action that's going here. All right, so two trades I want to just talk about briefly. This is a trade that I definitely learned some valuable things on, but I did not handle this trade well at all. This is Acacia Communications. So I bought this stock. I bought this a couple times, but one of my buys was here on this breakout, on this gap up day after they reported earnings. Okay, huge move to the upside, huge volume. So I bought this, and as the stock went up and it pulled back here, you can see it pulled back a couple times. I was looking for it to form a new base here. And you can see here that it held around 100, and it held here around 103. So I had my stock set to 100, because 100 is, that Jesse Livermore called it the century mark. It's a level that stocks will often, if they go through there, they'll often find support there afterwards. And what I was looking for here is I was going to hold the stock until it either broke the 10-week moving average, or it pulled back pretty significantly off the peak. And if you look back here at the original IPO base, it was 19% deep. All right, so 19% was basically the biggest correction, the biggest pullback that the stock experienced since going public. So I was looking at the same thing here. If the stock pulled back around 19%, then I was going to start thinking about selling this thing, because I didn't want it to, another 19% correction here would be reasonable. If it gets much bigger than that, I'd start to be a little concerned. So this stock, you can see it bounced off my stop here, and then I ended up selling this thing on this day right here, because it closed. You can see it closed under 100, and it was as low as 98 during the day, and I expected really good support to kick in at 100. And as it turns out, this was a horrible trade, because at least I think so, because the stock was so close to the 50-day moving average here, and that's a really huge support level. So we've got the 100 mark, we've got the 50-day moving average here, The other thing to consider is as the stock pulls back here, volume is declining down here. You can see volume's declining, and volume dried up on this day, the day I sold. And you can see what happened the next day. It was up, and then this gap up was due to more like a news. They revised their guidance. And you can see now, I mean, we had them the gap down here as they said they're going to offer more shares. But the bottom line is I was pretty disappointed with this trade afterwards because I thought I should have given more credence to the fact that it was so close to the 50-day and that volume was low on this pullback day. So this was one of the actions I had in my quarterly review to really look more at the context. Don't just sell. You know, my stop was 100. I don't necessarily have to sell this. I could wait till the end of the day, and I may come to the conclusion that 99.50 is close enough that I'm not going to sell this because of these other factors I talked about. All right, another trade I want to talk about is Dave & Buster's. So this is a stock, and this is more like what I'm looking to do lately, is instead of waiting for a stock to form a base, like let's say if this ends up forming a double bottom, instead of waiting for the breakout point up here, I want to buy while this thing's forming its base. And you know, this could be, some people argue this is a little riskier because you don't know when this thing's going to bottom out here. But as one example here, as this, you know, this stock had one leg down here, it came back up. And then we had a gap down here on earnings, but this stock still has pretty strong fundamentals overall. So as it was pulling down here, I'm looking for it to form a double bottom like I drew here with this green line, and I'm looking now for it to come back above the 200-day. So this is to me these are the types of setups that these are more like, and you're anticipating that it's going to potentially set up a base. And what you could do here is if this breaks through the 200-day, you could make that your, maybe take a 50% position, and then when it breaks the 50-day, you could take the rest of your position. And this way, instead of buying way up here with the breakout, which like I said, I personally have found breakouts to be not the best places to buy over the past couple of years, because a lot of people sell into them, it seems like. If you can buy in down in here as it's forming the base, now there's no guarantee it's going to finish a base, and there's no guarantee it's going to break out. But if it does, you'll be in down here, and now if you get some volatility up in here or up in here, if it goes to new highs, you can sit through that. So I think I personally think this is a more sound strategy to anticipate that a stock is forming a base, and watch it and plan your buying ahead of time instead of waiting for the breakout. That's just my opinion. Just based on experience this past 2 years. Okay, so those are the only couple of trades I just want to talk about there. So if you found this video on YouTube and you're not a member of the meetup group, then you can join the group by following this below link. You do need a free meetup account. It only takes a few minutes to set up, and files like this presentation and the quarterly review that I mentioned are only available to members of the meetup group. And if you're a meetup group member, you'll also be notified when new videos or new files are available. I didn't get any questions last month from members. Actually, I take that back. I did get one after I made this video, but I'll put it on the next month's presentation. So for next month, I'm going to continue going with the CanSlim Back to Basics review. We'll talk about the A for annual earnings growth. I'll also talk about pyramiding, which is the concept of instead of buying your position all at once, it's about building up and buying smaller bits of the position as the stock is moving upwards. So if you have suggestions for future topics, please contact me on Meetup. I check all my messages on there, and I respond to any questions there. So if you have any suggestions, I'd appreciate it. And thank you to one of our members, Steve Hart. He attended our last Meetup, and he gave me a couple suggestions for improving these videos. And I try to incorporate some of that today. All right, thank you, and have a good day.